Hey everybody, welcome to chapter 9. I'm sorry, chapter 8. This is lesson 9. See, even I get confused by that whole chapter lesson business. Anyway, chapter 8, reporting and analyzing receivables. If you remember, a receivable is an asset that represents money owed to you by someone else. So this whole chapter focuses on receivables and how we deal with them. There's the learning objectives. You can read through them, pause it if you want to take more time. There's the preview, it's kind of like an overview. It shows how it's broken down into 5 little sections. Again, if you want to spend time on that, you can. We'll just kind of jump into the types of receivables. And kind of they're broken down into account receivables. Those are amounts customers owe on account that result from the sale of good or service. So if I sell something to my customer and they don't pay me at the time of sale, then I have an account receivable. There's trade receivables. Those are written promises. They're usually more formal than an account receivable from a customer to pay me. And then non-trade receivables would be like if I loaned money to somebody or gave a payroll advance to an employee. So that's money owed to me but not part of my regular business transactions. All right. Anyway, yeah, you can read that. I'm moving on. All right. So there's 2 issues we have to deal with our accounts receivables. First is we have to recognize the accounts receivable, as in when do we recognize that this money is owed to us? And 2 is valuing the accounts receivable. How much is the accounts receivable worth? In a perfect world, we'd like to say that if somebody borrows $1,000 from us, then that's worth $1,000, but we know that some people don't pay their money back to us. And so we've got to usually figure out about if $10,000 is owed to us across all of our customers, we've got to have some way to estimate about how much of that we'll collect. Anyway, so the first concept, recognizing the receivable, we recognize the receivable when we earn it, okay? So when I provide a good or service to somebody, then I record that as a revenue, and if I don't get paid, then I record it also as a receivable. If I get paid, there's never a receivable because I got paid cash for delivering the good or service. All right, so here's an example. Assume the DoorDash company on July 1st, 2014 sells merchandise on account to the Polo Company for $1,000, terms of 210 net 30. Prepare the journal entry to record the transaction on the books of DoorDash. Okay, so we sold it. They didn't pay us cash, so our accounts receivable will increase. That's an asset, so it's debited $1,000, and our sales revenue will increase. That's a revenue, so it credits $1,000. On July 5th, Polo returns merchandise worth $100 to DoorDash. Okay, so they haven't paid us yet, but they return some merchandise. So what we have to do is reduce our accounts receivable by crediting it, and the debit goes on our sales returns and allowances account. We've already done that in previous chapters. On July 11th, DoorDash receives payment from Polo Company for the balance due. So if they originally owed us $1,000 and then we credited them $100, they should owe us $900 now. So, well, I almost messed up. Plus they took advantage of the discount. Remember, we did that in the previous chapters as well. So they paid us $882. We record our discount of 2% on the $900 for $18, and our credit will be the accounts receivable account going back down to 0, meaning we had a debit balance of $900. We now credit it $900. All right. Some retailers issue their own credit cards. Assume that you use your JCPenney company credit card to purchase clothing with a sales price of $300. So accounts receivable. This is from JCPenney's perspective. Okay, you owe them $300, and the sales revenue goes up by $300. And then it says, assuming you owe $300 at the end of the month, and JCPenney charges 1.5% per month on the balance due, your accounts receivable will increase by $450. And they'll have an interest receivable of $450. All right. So our accounts receivable is always a current asset, meaning it's due within a year, and we value it at something called net realizable value. Net realizable value means the total amount we're owed less any amount that we believe is uncollectible. All right, so there's 2 ways for us to figure out what's uncollectible. The first is what's called the direct write-off method. It is not the preferred method, and it's not the method used by almost anybody in business, okay? But it's still there. The problem with it is that what we do is we just wait until someone can't pay us, and then we write that off. Sounds simple, and it makes sense. So if somebody owes me $1,000 and they call me and say, look, I can't pay you, then I go ahead and I write that off, meaning I get rid of the account receivable by crediting it, and I take an expense, a direct write-off expense. The problem with that is it doesn't match things up well. Like if you bought something from me this year and told me next year that you can't pay me, and then I take that expense for not being able to pay, well, it doesn't match up with the revenue that I recorded in the previous year. And so it really throws things off. So instead, what companies use is the allowance method, where they estimate how much they think they might lose based on past experience. A lot of times you recognize that you're only going to ever collect 90% of what's owed to you, and the other 10% you won't, or whatever amount that is. You kind of use past experience to estimate it. Then at the end of the period, you go ahead and record that write-off for that period, and put it into an account that's called an allowance account, and I'll show you how we go about doing that. If you're following GAAP, which most of us have to, then you have to use the allowance method. Downside, it's a little bit more complicated. All right, so this is what it would look like if $500 was owed to us. We'd have an account receivable of $500, and if we thought we weren't going to be able to collect $25 of that, then we would have an account called allowance for doubtful accounts that would offset that. Okay, it's a contra asset, and it offsets the accounts receivable account. Here's what it would look like on our balance sheet. We'd have accounts receivable of $500 less the allowance for doubtful accounts, giving us a net realizable value on those assets of $475. Sometimes it's also shown like that on the balance sheet. So if this was the balance of our accounts and then we sold some more stuff on credit, we would now have a $600 balance on our accounts receivable. Then if we collected $333 of the money that was owed to us, it would be a credit. We'd have a balance of $267. Then if we used our estimate to figure out that we don't believe we're going to collect $15 of the money that's owed to us, we would do a bad debt expense of $15 and an allowance for doubtful accounts. Again, what this lets us do is take the expense now instead of waiting until next year when we find out for sure we can't collect the money. So we use a process, and we'll learn more about it going forward here, to estimate the amount we can't collect, and then we enter that as an allowance for doubtful accounts. Then we hit some point where someone actually tells us, hey, I can't pay you. And we agree with them and we write off the amount. At that point, what we do is we reduce our accounts receivable by the amount we're writing off, and we reduce our allowance for doubtful accounts by that amount, because that is completely gone now with no chance of getting it back. And that's how it would look on our balance sheet. All right, so the direct write-off method, again, this is the one that we don't typically use. Still, they want you to know the basic idea of how to do it. So here's the example. Assume that Ward & Company writes off M.E. Doran's $200 balance as uncollectible on December 12th. Wharton's entry is as follows. Bad debt expense, $200. Accounts receivable decreases or is credited $200. Again, we don't usually use that. Instead, we use the allowance method for uncollectible accounts. Here's the process. We estimate the uncollectible amount. We debit a bad debt expense. And that, again, that lets us do it in this period instead of waiting until some future point and when they tell us they can't pay us. And then we credit an allowance account called allowance for doubtful accounts, which is a contra asset account that offsets the accounts receivable account. Companies debit the allowance for doubtful accounts and credit accounts receivable at the time a specific account is written off as uncollectible. So that's the process. All right, so Hampson Furniture has credit sales of $1,200,000 in 2014. and $200,000 of that remains uncollected as of December 31st. The credit manager estimates that $12,000 of the sales will be uncollectible. So they have $200,000 owed to them, and they believe they won't be able to collect $12,000 of it. If they wait until next year when someone finally says, hey, I can't pay you, and they take the bad debt expense then, it's going to throw off their books, right? Because that expense will be part of next year's expenses, when really it should be part of the 2014 expenses, because that's when the sales were made. So instead, we're going to do an estimate, and we're going to say bad debt expense, debit $12,000, and allowance for doubtful accounts, credit $12,000. That allows us to take the expense now, and then in the future, when people call and say, hey, I can't pay you, we'll remove that from the allowance. So here's what our balance sheet will look like. Accounts receivable of $200,000, less the allowance for doubtful accounts of $12,000, gives them a net realizable value of that accounts receivable account of $188,000. All right, so the Vice President of Finance, Hampson Furniture, on March 1st authorizes a write-off of $500 balance owed by R.A. Ware. So when somebody actually decides they can't pay us and our management approves it, then we go ahead and write it off of our books. We take it off of the allowance account by debiting that account, and we take it off of the accounts receivable account. You'll see that the net realizable value won't change, right? Because accounts receivable minus the allowance for doubtful accounts gives us our net realizable value. So it won't change that. Instead, it just reduces the accounts receivable and reduces the allowance account all at once when we write it off. Here's the recovery of an uncollectible account. On July 1st, R.A. Ware pays the $500 amount that Hampson Furniture had written off. This happens sometimes where you think this customer is never going to pay me, and then they pop up months later and say, hey, we got some extra money and we want to pay our debt to you. And that's wonderful, right? It's a great thing when people are honest. But then you're like, shoot, what do I do in my books? I already wrote that off. So here's what you do. You increase the accounts receivable account again, and you increase the allowance for doubtful accounts. In essence, you reverse the write-off. Then you show the cash going up by $500 and the accounts receivable going away. That's it. So how do we go about estimating the amount of the allowance? There's a couple ways companies do this. Sometimes they do it as what's called a percentage of receivables. So oftentimes companies figure out that, hey, a certain amount of our receivables just aren't going to be collectible, just from past experience. So they simply figure that amount out from past experience. Maybe they go back and look at the last several years and say each year there's always 3% that's uncollectible. And then you just multiply that by the amount of your accounts receivable, that 3%, and that gives you the estimate of how much is uncollectible. That's a very simple way. Another way is by aging the accounts receivable. Here you can see they have split up the amount that's owed to them by how far past due it is. And you can see there's some that's not due yet. You can see there's some that is 1 to 30 days past due, 31 to 60, and so forth. And then they would analyze their past payments, and in this case, they realize that money that's over 90 days past due, is much harder to collect, and they're only going to collect about 60% of it, meaning 40% of it's going to be uncollectible. And they kind of do that for each of the little different categories of money, and in the end that gives them an estimated amount uncollectible. So that's another way. It still involves a percentage of the overall accounts receivable, but it recognizes that some categories of money are harder to collect on than others. So here they're going to give us an example. Assume the unadjusted trial balance shows an allowance for doubtful accounts with a credit balance of $528. Prepare the adjusting entry, assuming $2228 is estimated is the estimate of uncollectible receivables from the aging schedule. So this is confusing sometimes, but you think about it. What you do is at the end of the year, you estimate how much you think is uncollectible, and then you want to bring your allowance for doubtful accounts account up to that amount. So if they had a balance of $528 in that account, and they thought, but they're using their estimating that the balance will be $22.28 that they can't collect. What they have to do then is do an adjusting entry at the end of the year to bring the account balance up to $2,228. So you take the 520, you take the 22.28, subtract the 528 that's there, and that tells you the amount of the adjustment. So by adjusting the account by $1,700, that brings the balance up to $22.28, and that's the amount of their expense, $1,700. And there's the journal entry. So one last thing, that I don't know if they even cover it in this book, but another way that companies choose to calculate that allowance is some of them do a percentage of sales rather than a percentage of receivables. So they just find that, hey, if we've sold $1 million worth of stuff on account, we know that we'll collect 97% of that, and then we won't collect 3%, so they just multiply their sales by 3%, and that's how they come up with the uncollectible amount that they do for their allowance. So I've seen companies do it that way too, but it's not covered in this chapter, I don't think, or not in this slideshow anyway. All right, so we talked about accounts receivable. The next are notes receivables. Note receivable is when a company grants credit to someone else, and it's usually more formalized. People fill out or actually sign a note where they promise to pay a certain amount at a certain rate of interest. This is kind of what a note looks like, or at least this has all the elements of a note. It has the amount. Sometimes that's called the face amount. It has the date. It has the due date. And then it has the payee. And it has, again, the amount spelled out there. It has an interest rate. And it has the maker of the note. So that's all the information that's on a note usually. Maturity date is usually expressed in terms of either months or days, and we compute the interest by multiplying the principal or face value of the note times the annualized interest rate times time, where time is always expressed in terms of 1 year. Why? Because the interest rate is expressed in terms of 1 year, so we also have to express time the same way. So if our note is 6 months, we express that as 6/12 of a year, 6 over 12. If it's 120 days, then we would say 120 over 365. That's important to recognize. Another thing that's important to recognize that people get confused on is, well, I said 365. I think the convention in this book is 360. There's a problem in the financial world where some people use a 360-day per year convention. Others use a 365. For this, they're showing us 360. Double check your book when you're doing your homework. Anyway, so here's another thing that confuses people. When counting days, omit the date the note is issued, but include the due date. Okay? So just, you'll see what I mean when you do some of the homework and you have to figure out how many days a note is. You omit the day it's issued, but include the due date. So here's some examples. $730 note, 12% interest rate times 120 days. So they figure that out by saying 730, which is the face amount, times the rate of 12%, or 0.12, times the time of 120 divided by 360, or 120 out of 360 days. A 6-month note, $1,000, 9%, 6 times 6 over 12. And a 1-year note, that's easy. It's just face amount times the rate times 1. All right. So here's an example. Brent Company wrote a $1,000 2-month 8% promissory note dated May 1st to settle an open account. What entry would they make upon receipt of the note? Well, they would show notes receivable going up. Receivable's an asset, so it's debited. And accounts receivable going down. They're paying off the accounts receivable. That happens on May 1st. Again, notes are shown at their net realizable value. And we sometimes have to estimate how much is uncollectible, just like we did with accounts receivable. Sometimes we have to dispose of a note receivable. There's 3 ways you dispose of one. Either they get paid off at their maturity date, that's the way they're supposed to be handled, and so we have to dispose of them or get rid of them off our books once they're paid off. Sometimes the maker of the note defaults, and the payee has to make an adjustment. And sometimes the holder of the note speeds up and converts the note to cash by selling it. you can actually take it because it's an asset that you own and sell it to somebody else. And there's companies that do that. They're called factors. And what they do is they buy accounts receivable and notes receivable. So if I have $10,000 owed to me, they might offer me $7,500 in cash, and I'll take that cash today. And then they'll hold the note and receive the payments on it and end up getting $10,000 back. They take the risk of holding it and collecting it and pay me some amount of it up front. So those are the three ways we dispose of a note receivable. Here's just some terms. A note's considered honored when the maker pays it in full, as they promised, and dishonored if they don't. All right, so here's how we record an honored notes receivable. Wolder Company lends Higley Inc. $10,000 on June 1st, accepting a 5-month 9% interest note. Wolder presents the note to Higley on November 1st, the maturity date. Here's how we would enter it. Our cash will go up by $10,375. That's the $10,000 principal plus $375 in cash that we calculated by multiplying 10,000 times 9% times 5/12. Our notes receivable will go away, right? That asset notes receivable is gone, $10,000, and our interest revenue, the $375, gets recorded. So that's a standard recording of an honored note. Sometimes, though, a reporting period intervenes. Like maybe if this company did quarterly reporting, they would have to do an adjustment somewhere along the line and record the accrual of that interest receivable. So here's the example. The Wolder Company prepares financial statements as of September 30th, so at the end of the third quarter. So they have to do an adjusting entry to recognize that they've earned 3 months of that interest as of that date, September 30th. So they would record interest receivable at that point of $300 and interest revenue of $300. I'm sorry, 4 months, 4/12. So $10,000 times 9% times 4 out of 12 equals $300. Then when they actually get paid for the note on November 1st, the cash should go up by $10,375. The notes receivable would go down by $10,000. The interest receivable that they had recorded during their adjusting entry, that would go down by $300. And the interest revenue would be 1 month's worth of interest revenue that they've earned since the adjusting entry. So you might see something like that in the homework. Managing receivables. In real life, business owners and managers have to make these decisions, and this is the steps you follow. You determine to whom to extend credit, if they're worth lending money to or not. Not worth it as a human being. Everybody's worth something as a human being, but we're talking about worth the risk, right? We establish a payment period. We monitor the collections to make sure they're happening. Evaluate the liquidity of the receivables. That's what we just did, where we were saying how much of this do we think we're going to collect in cash. And then sometimes we accelerate cash receipts from receivable when necessary. And I mentioned that we do that by, a couple ways. One is you can sell your accounts receivable to a factor, but the other is you can encourage people to pay it off early by offering them a discount. If I'm only going to get 75% from a factor for selling it early, maybe if I just call the client and say, I'll give you a 5% discount if you pay that debt off early, they'll do that and take advantage, and I'll get 95% of the money. So there's different ways to accelerate cash receipts. When we extend credit, companies that are too tight with it, they lose customers and they lose sales. And if it's too loose, then you sell to people who won't pay you back. So it's a challenging thing. Again, you can read that. I won't read it to you. You just have to be smart about establishing the right payment period. Again, we keep track of our collections, make sure people are paying us, and then evaluate the liquidity, again, which we talked about. There's a couple of ratios we use to evaluate liquidity. They include accounts receivable turnover, which is our net credit sales. A lot of these problems won't tell you which sales are credit sales and which are cash, and so if they don't, then we just consider all sales as cash for those problems. You might see that come up. Your net credit sales divided by your average accounts receivable. And again, to find your average accounts receivable, you take the accounts receivable at the beginning of the period, add it to the accounts receivable at the end of the period, and then divide by 2, and that will give you the average. And then our average collection period, which is, and here now they're showing a 365-day convention, number of days in a year, divided by the accounts receivable turnover. I mentioned the idea of accelerating cash receipts. This says there's 3 reasons for the sale of receivables. And there you go. So like I said, you can sell them to a factor. You might get a problem that's like this. It'll say, assume Henderson factors $600,000 of receivables to Federal Factors, Inc. Federal Factors assesses a service charge of 2% on the amount of receivables sold. So in essence, they collect 98% of it, $588,000 in cash. They record the $12,000 as a service charge expense, and they reduce their accounts receivable by the full $600,000. Sometimes we have credit cards. When we use a credit card issuer, then really it's almost like cash to us. We're not really extending credit. That's why we use credit cards, right, as business owners, is it allows us to extend credit to our customer, but we don't have to take the risk. Instead, we just pay a service fee. Usually it's between 2 and 4%. So Morgan Marie purchases $1,000 of compact discs for her restaurant. She charges this amount to her Visa card. The service fee that First Bank charges the music company is 3%. So from the music company's standpoint, they're going to show their cash going up by $970, a service charge expense of $30 or 3% of the $1,000, and sales revenue of a total of $1,000. That's how they'll enter it. That's the end of the chapter. I think this is pretty doable. Again, if you get stuck or if things just aren't making sense, please, you can email me. You can post it in the discussion board, which is a great place because that lets others answer you as well, or it lets others see my answer to you so they can profit thereby, I guess. You can also call me or text me if you need help. I will do my best to help you. Have a great week and have a great chapter, and look forward to the fact that in this chapter there's a little less work than in some of the previous chapters. Good luck.